A critical mass default happens in an over-indebted economy that results in a chain reaction of defaults. Bankers and the mainstream media will casually refer to this as a Lehman moment, but the rest of the world will come to know the next Lehman moment simply as the collapse. Here are your collapse trends for March 7th, 2017. $1 million home contagion spreads to Toronto suburbs. Toronto home prices jumped more than 20% in February for the sixth straight month as listings dried up, pushing the price of suburban house beyond $1 million Canadian dollars for the first time. The average home in Canada's biggest city, including condominiums, detached, and townhouses, climbed 28% to approximately $875,000 Canadian dollars last month from the prior year, as active listings were cut in half to 5,400, according to a report from the Toronto Real Estate Board released Friday. Meanwhile, in the suburbs, which cover the 905 area code, the average detached home price soared 35% to 1.11 million Canadian dollars from last February, the fastest growth of any housing type in the Greater Toronto Area. Detached home prices in the core of the city continue climbing up to 30% to 1.57 million Canadian dollars. Many are pulling their home off the market in hopes that the prices will go higher, or they just don't want to sell because they still need to quote-unquote buy another house. The average home price in the city is equivalent to about 10 years worth of median family income. Traditionally, 5 years of median family income is what's considered a normal price for a home. What many homeowners fail to realize or simply don't want to look at is, as Chris Martinson from Peak Prosperity states, the money to pay back the property loan comes from wages. Ergo, property prices and wages cannot depart from each other forever or even for very long, without a lot of repayment defaults resulting. Cliff High from HalfPastHuman.com has imminent data sets within his predictive linguistics report of interbank credit problems. These bank credit problems are going to be the proximate cause for housing being dumped on the market and discounted as credit freeze sweeps throughout the regional banks. Definitely a collapse trend to keep an eye on. Auto lending update. Someone please explain how this is not a bubble. Experian recently released their Q4 2016 automotive finance market update, which includes a lot of statistics which raises concerns about the sustainability of the current level of annual auto sales. First, there's the staggering growth of auto loans outstanding. It should be readily apparent to almost anyone that a 21% expansion in credit issuance over the course of just 2 years implies that there has been at least some degradation in underwriting standards. But you don't have to speculate, as Experian lays out the facts, and sure enough, the outstanding loan balances of deep subprime borrowers have increased by double the amount of any other bucket, other than simple, plain subprime folk. Of course, an impaired credit profile has in no way hampered America's entitled consumers' demand for driving around in style, as average subprime loan balances actually exceed that of superprime. But don't worry, those subprime borrowers can afford those loans because they simply offset higher interest costs with stretched out terms, which keeps their average monthly payments low. But despite all the financial engineering, a look at the 60-day auto delinquencies around the country may imply that the auto party is slowly coming to an end. The Pension Benefit Guarantee Corporation, an entity created to guarantee pensions of private corporations, is on the verge of bankruptcy. This is one of the biggest and most serious collapse trends to look out for. To understand how big of a deal this is, here's the PBGC's actual mission statement. The Pension Benefit Guarantee Corporation protects the retirement income of more than 40 million American workers and nearly 24,000 private sector defined benefit pension plans. A defined benefit plan provides a specified monthly benefit at retirement, often based on a combination of salary and years of service. PBGC was created by the Employee Retirement Income Security Act of 1974 to encourage the continuation of maintenance of private sector defined benefit pension plans, provide timely and uninterrupted payment of pension benefits, and keep pension insurance premiums at a minimum. PBGC is not funded by general tax revenues. PBGC collects insurance premiums for employers that sponsor insured pension plans, earns money from investments, and receives funds from pension plans it takes over. As retirees of the Local 707 found out in New York, retirees could expect to see their benefits slashed up to 80%. In other words, less than 1/8 of $570 average check PBGC is able to give the Local 707 retirees now. However, don't fret, as Hollywood has a potential solution to the retirement problem found in the upcoming movie Going in Style. It's about 3 retirees, Morgan Freeman, Michael Caine, and Alan Arkin, who have had their pension payments unjustly suspended, so they decide to rob the bank that has their pension funds. Click the link in the description below to watch the entire trailer with sound. Going in Style comes out in theaters April 7th, 2017.